Okay, let's kind of lay this out for a moment. We've quickly gone from the hard landing worry of last year to the soft landing consensus of the first quarter to maybe stagflation or inflation for longer now. Where does that leave the markets?
Yeah, and thanks for having me on again, Kelly. So yeah, as you alluded to, I think it's important to talk about the setup in terms of how we got here, right? We started the year with the Fed pivot fully priced, then to higher for longer, which the equity markets have now seemingly digested. But stagflation risks are seemingly creeping back up again with some of the recent macro data in terms of GDP, PCE data, ECI, for example. So we wanted to get a sense on our side, what sectors are mispriced for that risk, even though it's not our economists' base case, right? As you alluded to, no one really wants to say the R word anymore, at least when we talk to investors. And what our models are suggesting is a strong defensives and commodity-centrics versus cyclicals tilt, so very 2022-esque. And gold miners are really the only industry poised to potentially outperform in that scenario.
Gold miners would outperform in stagflation?
Yeah, and you know the reason we think is because gold miners, especially relative to traditional miners, we think that's an interesting relative value pair. It's geared to economic cyclicality, and it's sort of a gold alpha trade, so to speak. And you're really seeing this play out already in the earnings stories, given the rally the actual commodity has had, right? So gold miners are seeing stronger earnings momentum and trade at a roughly equivalent valuation multiple to the traditionals.
And we were just talking about how the banks have been a good trade over the past year, but it would sound like banks go into the steer clear or long put candidates, I think, as you've described it here, along with consumer discretionary. And even why is materials in that basket?
Yeah, look, I think it's, you know, as I said before, it's very 2022-esque, and it's, you know, a top down, it's very defensives over cyclical. So we've been getting a lot of questions, for example, recently on utilities, right? So in the utility space, you've had obviously these idiosyncratic stories with some of the electrification companies as second derivative beneficiaries of the AI narrative. But we think these sort of bond proxy defensives could work well in an environment where, let's say, rate cuts continue to get priced back in, or even worse, if stagflation risks start to come back into the narrative, as we've been suggesting.
Do you think this market overall can continue to do okay?
Look, you know, what we said at the start of this year was that if tech and AI and growth stocks in general kind of remain at the helm, the S&P 500 index remains a very high quality index, right, in terms of balance sheet, in terms of profitability. You know, so the real story this year is the bifurcation you've seen in earnings momentum of tech and AI versus everything else, cyclicals and defensives. I think what's actually interesting is you're starting to see a broadening out, right, especially with the AI tailwind. So as I mentioned before, a lot of the utils companies starting to benefit. So you're starting to see earnings momentum pick up in those spaces. So if anything, it's actually somewhat healthy, unless you get a real slowdown in growth and stickier inflation and higher unemployment.
You sound like Dan Suzuki. You're kind of coming to his conclusion about this broadening earnings. So it's very, very interesting. Real quickly before we go, what do you make of the VIX these days? Where do you think that goes next?
Yeah, it's a great question. We've been tracking it very closely, especially over the last month. Look, equity volatility has retraced pretty sharply. When VIX was at 19, we were pounding the table. We basically said this is only warranted if realized volatility can keep pace. That was trading 8 points under at the time. So since then, volatility risk premia has totally eroded post FOMC, NFPs, and obviously as geopolitical concerns have waned in terms of equity markets. You know, look, VIX should normally trade at a 2 to 3 point premium to S&P realized volatility, but realized has actually been sneakily on the rise. So we've been saying right here, right now, ahead of CPI on Wednesday, we think volatility risk premia is actually due for a moderate rise, you know, this week in the short term.
Very interesting. I'll let people take conclusions from that about what they may about what the data says. Maxwell, for now, thanks so much. We appreciate it today.
Thanks, Kelly.